It's the complete opposite in the equity market, which is actually, I think, stronger, makes a stronger statement. In the equity market, you have massive insider selling, and the big money, the insiders over the last 4 weeks, the institutional have sold 4.2 billion last week. Over the last 4 weeks, 2 billion per week, as the insiders are as the retail mom and pop are at the largest amount of stock exposure ever in history. They're all in on stocks. That says something, I think, about where the direction of the stock market may be going. The insiders know the scoop. Well, look at the same thing in reverse with the metals market, the biggest money in the world. The central banks, the sovereign wealth funds, the family offices, they are draining the world's exchanges, as you know, standing for delivery. The largest delivery in the history of the COMEX market, I believe in both gold and silver, occurred in May. You can correct me if I'm wrong on that, but I'm pretty sure it did. About $8.5 billion worth of gold was delivered in May, about 4.5 in March. The biggest money in the world is accumulating gold and standing for delivery. And the odd thing about it, to your point, is that the retail investor is immersed in the risk-on trade, immersed in traditional, equities and the traditional form of investing. And you have to wonder if the insiders are massively selling on equities as the retail investors are buying. But it's the opposite in gold and silver. Who's going to be right? And my guess is those closest to the information are right. And that to me is very telling. But yeah, you're right. The people on this side of the table in precious metals are missing out what's happening. And that's why we see the lowest premiums we've seen really in a very long time on metals. It's a lack of demand on the retail side more than anything, which is very, very confusing and hard to understand when you see what's happening up there. I'd be curious to your take on the post that Chris Marcus put out last week. And I've always admired Chris's ability to chase down the story from an investigative journalistic standpoint. He's one of the best in this space. And he was talking about the fact that when you have large short positions on COMEX, that they're supposed to typically be offset with long positions in London. And he was framing it with the respect that if indeed the massive short position, the second largest ever in the history of the COMEX by the commercial banks that we see right now, if indeed it really is offset in London, where we're told they have somewhere in the neighborhood of a 250 million ounce float, if they're offset, he was saying that means there's only 7 million ounces in London that is not encumbered, something to that extent. And if it's not offset, if it's not hedged in London, that means a bank like Bank of America, typically something like that. According to Ted Butler, when he was alive, he would have said it would be Bank of America. But that means that there are banks or a bank that are wickedly, wickedly exposed to a rise. And maybe that's why we've seen on Wednesday of last week, 487 million ounces on paper traded, and on Friday, 356 million ounces. They are trying, by trading 800 million ounces over 2 days, to keep the price below $37 for sure. No, I really can't, because it defies logic. It's as if they are trying to, you could argue they've been the model of inefficiency for a long time. They're trying to perhaps just get the littlest amount of silver, like your interview, the interview that you did that I think everyone needs to listen to. The 2-part interview or 3-part interview, Jack Sermon, I think his name was. And it's one of the 2 go-to interviews that I would tell anyone who wants to know what's going on to listen to. And in it, when he said, I was told by my superiors to only produce just enough silver eagles to not create a backlash, what am I trying to say? A media backlash, or a something that we're going to have to try and quell. Well, that's obviously what they're doing. And because everything else premium-wise has reacted far differently than the American Eagles, which have maintained their premium, not high premium, but higher than everything else, simply because the demand or the supply is not meeting demand. And which is weird, because there's plenty of product on everything else, but Silver Eagles have really been that one item that has maintained demand, but the supply just isn't where we would expect it to be. I don't know. I guess I take a lot from that interview that you did with Jack, and I never thought I would hear a Mint official say he was told by his superiors, and I don't know who those superiors would be. I doubt it would have been the lady that used to run it, the HR lady. I forget her name.
Citrus Gibson.
But yeah, whatever, Gibson. But I think it would be more along the lines of the Treasury Secretary, who would have given him those those instructions. But yeah, there's no question, really. I mean, you look, they haven't even made a platinum eagle yet this year, and you can see that they're very, very inefficient. But it's almost as if maybe they are restocking the American government. Perhaps, and using stupid excuses and lack of transparency and the admission by Jack that yeah, just make as little as possible without creating a backlash that they're doing. Maybe they realize, along with all these imports and deliveries into the United States, that we have allowed this to become a very detrimental situation to the safety of the country, that we are woefully understocked in things like gold and silver, and that's why they're delivering it into the system. Maybe it is the Treasury that is behind all of these big deliveries. And on one hand, we can't make the admission that we're woefully underprepared for the future as it pertains to something as strategic, not just industrial, but strategic as silver, and at the same time let it all go out the back door to the American public. So, I mean, that would be the only thing that would make sense to me, Bix. I can't think of any other reason why they would go to such great lengths to keep silver eagles from the public when it's in the law, the charter of the mint, that they're supposed to produce as many as is demanded by the public, which they clearly haven't for the better part of 5 years.
So let me just kind of continue pulling on that thread, because it's so crucial to understand how twisted this entire system has become and why the desperation to keep the lid on silver and gold is reaching absurd levels. You know, I sit here and watch these COMEX reports, these delivery figures, and I'm telling you, there is something absolutely monstrous brewing beneath the surface. We had the single largest gold delivery month ever in May. Something like $8.5 billion worth of gold stood for delivery. Just a couple months prior in March, we saw over $4 billion, and this is just in New York. Meanwhile, on the Shanghai Gold Exchange, they're clearing tonnage after tonnage at rates that dwarf official reported demand. And it's not just gold. Silver's the kicker here, because the largest physical silver delivery month ever recorded also happened recently. Now contrast that with what's happening on the retail side here in the US. Mom and pop investors, they're all in on the stock market. They've got record equity exposure. Margin debt is at all-time highs. You've got the average retail investor dumping everything into tech stocks and ETFs, lured by the promise that the Fed's got their back. Meanwhile, who's quietly dumping stocks? Insiders. Big money, institutional money, has been selling an average of $2 billion a week over the last month. Last week alone, over $4 billion. That's historic scale, and to me, that's a chilling divergence. You look at the biggest money in the world, the central banks, the sovereign wealth funds, the multi-generational family offices, and what are they doing? They're draining physical metal off the exchanges like never before. They're not buying options or futures. They're standing for delivery. They want it in hand. While the retail public is going all in on stocks at peak valuations, after a decade of easy money that's pushed everything to nosebleed levels. Who do you think is going to be proven right? Then you have to ask, what's really holding silver down here at $34 or $35? Why is it that on Wednesday of last week, they traded 487 million paper ounces of silver, more than half of annual global mine supply, just to keep it from breaking $37? And then 2 days later, they traded another 356 million ounces, over 800 million ounces in 2 days. That's not trading. That's a controlled demolition. It's market engineering, pure and simple. Now, Chris Marcus did an incredible deep dive on this last week, and I give him full credit. His investigative work is some of the best in the space. What he pointed out is that under normal conditions, these massive COMEX short positions should be hedged in London. So you've got commercial banks sitting short nearly 1 billion ounces on COMEX, theoretically offset by long positions in the LBMA, where there's supposedly around 250 million ounces floating around. But if you run the numbers, and Chris did, it suggests that only around 7 million ounces might be unencumbered in London. That's basically nothing. And if these banks aren't actually hedged, then you've got a ticking time bomb, one serious delivery squeeze or a single failed auction, and it could be Bear Stearns all over again, only multiplied by 10. Because remember, it was ultimately the gold and silver shorts that blew up Bear. That's the little secret no one likes to discuss. And look at the shenanigans at the US Mint. That interview with Jack Schectman that you did, man, that was one of the most important revelations I've ever heard. For a Mint official to outright admit, on the record, that his superiors told him to only produce enough silver eagles to avoid a PR backlash, that's damning, because by law, the US Mint is obligated to meet public demand for bullion coins. They've failed that mandate for nearly 5 years running, and it's not like they can hide behind COVID anymore. Every other private mint is running full tilt. Generic rounds, sovereign coins from Canada, Austria, Australia, they're all available. Yet Silver Eagles have persistent elevated premiums simply because they've deliberately underproduced them. Ask yourself, who gave those orders? Was it really just HR lady Ventress Gibson, who, by the way, had no mint experience before Biden handed her that job? Or does it go higher, right up to the Treasury Secretary? Maybe even tied into national strategic policy. Because when you think about it, it's the only thing that actually makes sense. If the US government quietly knows we're woefully under-reserved when it comes to strategic metals like silver, not just monetary, but critical for defense, energy, tech, maybe they're trying to build up stockpiles on the sly. They can't exactly announce to the world, hey, by the way, we've neglected our reserves for decades, so now we're going to buy every ounce of silver we can find. That would send prices to $100 overnight. So instead, they squeeze down private demand, suppress price with paper games, and quietly facilitate massive imports through the back door. And when the US Mint does produce coins, they keep it to a trickle, so it doesn't all vanish into public hands. It's a theory, sure, but honestly, it fits the facts better than any official explanation I've ever heard.
Well, and it's funny, and although they didn't speak directly to silver, although I would argue the silver is the exact same thing, in fact, on steroids, the ECB warned that gold is a threat to the global financial system. I'll just read something to you real quick. I'm sure you saw this. Last month, the ECB, the European Central Bank, warned of increasing counterparty risk in gold derivatives for the euro area. In the May edition of the Financial Stability Review, the ECB added that a significant share of these gold derivatives were over the counter and not centrally cleared, leaving actors exposed to counterparty risk. As you said, the LBMA is not an exchange, it's an over-the-counter system, I guess you call it. The big point to take on board is an official recognition that the stand for delivery obligations on COMEX are behind the crisis, and they continue. Since November, warehouse stock has shown 26,470,000 ounces have stood for delivery. Eurozone banks have swapped gold for paper, and the gold is disappearing in deliveries. Behind the ECB's public concern is a far deeper one. It is as close as we can get to official warning that the gold paper game is coming to a very nasty end, likely to drive gold measured in paper currencies far, far higher. And incidentally, the same problem exists in silver, but without the central bank participation, more of a commercial bank, which means it's an existential threat to some of these banks if the shit hits the fan. That's in essence what you are saying, correct? I think we're seeing a shift. Now you have Singapore into the game and opening up a market, a gold market. They want pricing authority to shift towards Asia. And I think that's what is happening, whether it be with the Shanghai Metals Exchange now that's being developed in Singapore, the BRICS exchange. There's no question that I think they've realized for a very long time that the pricing power, the West monopoly on metals pricing and settlement is something that they realize is a scam. And I think that buyers in Asia aren't just looking for better pricing, they're seeking autonomy, they're seeking the ability to set the prices. This is a big deal that I think people are missing. And even when the BRICS grain exchange was developed last year, the guy that is behind it said, we in the global South produce and consume more grain than the West does, but we can't control the price. It's done on COMEX. But with the development of this grain exchange, that will change. I think you could say the same thing here about the move eastward. That's one of the scary things about the recklessness of the Western policies that are allowing the exchanges to be drained and flowing eastward to countries like India, countries like China, countries like Saudi Arabia and Russia, and all of the countries that understand what silver represents, standing for delivery. And maybe by the grace of God, someone in the Trump's administration said, look, we've got to do the same thing here or we're in big trouble, hence all of the deliveries we're seeing. I don't know, Bix, I know you had me on your show, but I'll ask you, I mean, When do we see the price suppression end? What does it take for this to be overwhelmed, for these banks to realize that this isn't just stupid, it's an existential threat to their survival? Are we getting there? Are we almost there?
I want to take us a step deeper into why I'm so confident this isn't just another commodity bull cycle. This is, quite frankly, about the very architecture of money coming under pressure in ways we've never seen in our lifetime. You can try to find an analog in the 70s when Nixon closed the gold window, or the late 90s tech bubble that eventually unraveled. But the closest comparison is probably the slow-motion, empire-ending debt implosions that you see when you study history across centuries. The fall of Rome's denarius, or Britain's post-war collapse of sterling dominance. Because this time, the debt is systemic, it's sovereign, it's the backbone of everything. It's not some overbuilt housing sector that needs to correct. It's the money itself, the treasury market, the collateral layer of global finance. And the world is clearly starting to prepare for a future where they don't want all their eggs in that same dollar-denominated basket. Let me lay out how the smart money is maneuvering around this. The central banks have been net accumulators of gold for 14 straight years. Last year was a record, over 1,100 tons. And the data we're getting from the World Gold Council is always understated because many central banks, especially China and Russia, don't disclose their true buying. Even Poland, Singapore, India are loading up. It's not speculation. These are sovereign decisions at the highest levels. It's a portfolio allocation to hard reserves, anticipating a shift. Meanwhile, the same elites who are offloading paper IOUs are methodically standing for delivery. You look at COMEX, you see gold delivery volumes exploding. May was the largest ever, over $8.5 billion. Silver set records too. And unlike ETFs where the custodian can play all sorts of games with synthetic exposure, these are actual warehouse receipts getting pulled, with metal going out the door. And then you have retail, the mom and pop crowd, who are sitting with their highest stock exposure ever. Margin debt is near extremes. They've got every last dollar shoved into Nvidia, Tesla, tech ETFs. And at the same time, insiders have been dumping stock. 4 straight weeks of over $2 billion in insider sales. Last week alone, over $4 billion. It's classic. Retail gets in at the top, insiders walk out the door. So you tell me who's reading the real weather forecast here. The insiders in equities are fleeing, while the biggest money on earth is standing for delivery in precious metals. I don't think that's a hard question to answer. And let's get into silver, because I think silver's about to steal the whole show. If you look at a long-term silver chart, go back to the 70s, you'll see it's only popped to $50 twice. Once was the 1980 Hunt Brothers spike, which was all speculation and fizzled quickly. Then again in 2011, where it almost tagged $50. Now here's the thing, since then we've spent over a decade consolidating under that level. Last year we tagged $32.70, dropped, then came back to $35 in October, dropped, then came back to $35 again in March. That's 3 hits, a classic triple top by old school chartist terms. Most retail traders look at that and say, oh, it failed 3 times, must be a ceiling. But that's wrong. What it's actually done is build a massive base, a launch pad. On momentum charts, which is what I rely on because they show the real internal energy, silver has been quietly correcting against long-term moving averages for over a year, while price stayed roughly flat. That's a cooling, a gathering of fuel. Now we're right at the edge of breaking that momentum cap. If silver closes a week above $35, or especially if it ticks above $36, it triggers a powerful point and figure breakout. The price will run, and I don't think it stops until it's well into the 60s or 70s. Why that range? Because $50 is ancient history. It's like an old ghost that means very little technically today. The actual coil that's formed could easily project into the mid-60s just on the mechanics of the breakout alone. That could happen inside a quarter. Not the ultimate top, just the first leg. Then you get volatility, a shakeout, another leg up. That's how all big moves unfold. The same goes for silver miners. If you map the spread between GDX or SIL versus gold, you'll see a clear underperformance since 2020. That's been a 4-year slide. Those spreads are now right at their technical breaking point. The first weekly closes above those structures will confirm that miners are finally going to outpace gold again. And historically, once they do, they tend to accelerate dramatically. You could easily see silver miners doubling or tripling faster than gold miners, and gold miners outpacing gold itself. Meanwhile, look at the fundamentals around silver. It's coming out of the ground at roughly a 6-to-1 ratio to gold. The historic monetary ratio over 150 plus years is around 15-to-1, and even that is distorted by over a century of government bimetallic price fixing. The modern era, last 50 years, has averaged closer to 45-to-1. Right now, we're around 90-to-1. If silver just mean reverts to a 45-to-1 ratio, while gold pushes to $8,000, which by the way is merely matching prior cycle multiples from low to high, you'd be looking at silver over $175. That's not pie in the sky. That's simply how major revaluations work. But honestly, what we're probably heading for isn't about chasing multiples. It's about a systemic recognition that gold and silver are money and that fiat experiments, every single time in history, blow up. You can pick your case study: the assignats in revolutionary France, the Reichsmarks in Weimar Germany, the Zimbabwe dollar, the Argentine peso. It always ends the same. What makes this cycle different and more dangerous is that the world reserve currency is now the patient on the table. The dollar is no longer untouchable. The BRICS are building parallel payment systems. The Shanghai Gold Exchange is opening vaults in Hong Kong, Saudi Arabia. So oil can flow from the Gulf to China settled in yuan, with gold to square the books. They're offering their cross-border bridge system to all non-BRICS nations. That means the majority of global GDP and over half of global population could be transacting outside the dollar system within the next decade. And that's why central banks are buying gold. They know exactly what's coming. They're preparing for a world where the dollar isn't the only option, or even the preferred option. And when that moment of recognition hits markets broadly, you won't be buying dips. You'll be watching an explosion, because there simply isn't enough physical gold and silver to go around at current prices. That's when you get vertical moves, shortages, forced delivery failures. Sorry, we can't get you product for 6 months. That's not a theory. That's literally how every historic monetary reset has looked. Now let me give you something that makes all this even clearer. The ECB recently put out a financial stability report. In it, they identified rapid gold price increases as a systemic risk to the global financial system. Just sit with that for a second. Gold, an inert yellow rock that earns no yield, is a systemic threat to trillion-dollar financial institutions. Why? Because it reveals the rot. When gold prices spike, it's like a giant neon sign flashing, "Your money is worth less." It breaks the illusion. And when the illusion breaks, the entire leveraged debt pyramid wobbles. And by the way, you're seeing subtle signs of that panic. Look at the 30-year Treasury market. Every time it tries to drop below certain levels, like 111 on the long bond futures, it finds miraculous support. That's not organic. That's stealth intervention. The Fed buying to keep the system afloat without spooking markets by outright QE announcements. Because if they let bonds truly collapse, yields would spike and the entire debt servicing mechanism of the US would break. You'd see immediate fiscal crisis. But holding it all together means ever more intervention, ever more currency creation, ever more systemic risk. And the only real hedge against that is the stuff they can't print: gold, silver. So where does this leave us? Well, the irony of all ironies is that the mainstream investor still views gold and silver as speculations. They watch CNBC and hear them say, "Gold was down $45 today, 1.5%. Panic." Meanwhile, Nvidia drops 12% in an afternoon, and it's just tech being tech. The psychological anchors are upside down, but that's how all paradigm shifts begin. No one believes them until suddenly everyone does. That's why I keep telling folks, stop trying to overthink it. If you understand even a fraction of the dynamics we've just laid out, the systemic debt problem, the real flows of gold from west to east, the technical breakout setting up, the obvious stealth accumulation by the largest players on Earth, Then you don't wait for the perfect moment. You accumulate your position. You don't chase tops. You accumulate during the boring, choppy phases when the big money is quietly standing for delivery. Because when this thing goes vertical, and it will, there won't be time to politely form an orderly line. And I'll close by saying this. I've studied every major commodity bull of the last 50 years, from oil's runs in the 70s and early 2000s, to copper's cycles, to the precious metals booms. The biggest moves always come with the highest volatility. The bull tries to buck off as many riders as possible. The way it does that is by violently shaking the tree. 10% corrections, fake breakdowns, headlines screaming doom. Then it whips around and rallies 20% in a week. That's how the market ensures most people miss the meat of the move. So if you're serious about preserving wealth in this coming storm, you need to accept that volatility is your friend. It means we're in the right place. It means the system is under stress. It means the end game is near. And one day, maybe not next month, maybe not even this year, but soon, we'll look back at 35 silver and 3,500 gold and say, wow, remember when it was that cheap? And by then, it'll be too late to build a position without chasing. So do yourself a favor, get positioned, then turn off your screen. Go live your life. Let the bull market do the heavy lifting. Because this next phase, it's not going to be subtle. It's going to be history in real time. And I'd rather be a year early than a day late.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.